Hi, welcome to this week's headlines. I'm Keith Kam. Here are the highlights. Two MACC officers, Datuk Rohaizad Yaakob and Datuk Bahri Mohamad were reinstated on Monday to their original duties after being transferred to the PM's department by the Civil Service Department last week. A massive explosion erupted in Tianjin city in China on Wednesday. It was caused by combustible and explosive goods stocked in a warehouse, resulting in over 40 deaths and 100 others injured. And speaking of China, our main story this week is its economy. The world's second largest economy after the USA, or maybe even the largest. Let's see what they've done now. So when Beijing decides to implement an economic policy, you can expect an actual Chinese tsunami. Earlier this week, the People's Bank of China decided to review the way the yuan exchange rate is determined. Now, the Chinese yuan, also known as the renminbi, unlike free-floating currencies like the yen, pound, euro, and even the ringgit, trades within a roughly 2% range, which is determined by the PBOC. Here's Manpreet Gill from Standard Chartered Singapore's Fixed Income and Currencies Unit to explain further.
China's currency control, it's ultimately the central bank manages the currency within a band around sort of a central reference rate, which the PBOC fixes as well. So that's sort of the range within which the currency is allowed to trade. And what we've seen today is really a move upwards in that central fixing rate. And obviously the band around that central fixing rate also shifts upwards. So that's sort of how the central bank manages the exchange rate. And the change has really been today about moving that central reference rate, the point around which the band is fixed, moving that upwards for $CNY.
Now, the move to lower that reference rate effectively devalued the yuan by up to 2%. Plus, it was a move that was unexpected. Now, the one thing we must always bear in mind is that traders around the world love stability, just like you and me. Therefore, any surprises will be met with knee-jerk reactions. On Tuesday, when the first devaluation happened, stock markets fell. Currencies throughout the world weakened against the US dollar, some more severely than others. My poor ringgit. And then it happened again on Wednesday. Although the depreciation was slightly less, this time by around 1.6%. Now this took financial markets even more by surprise because China's central bank assured after the first devaluation happened that it would be just a one-off thing. Surprise, surprise, right? Now the effects of this second round of devaluation was even more severe with markets around the world just falling like dominoes. Standard Chartered's Manpreet Gill explains more about the effects of the yuan devaluation in the world and in our region.
The impact itself from a currency alone is going to be quite small because remember at the end of the day this is approximately 2% move in the policy rate, and that's on exports which as a net contributor to Chinese growth today are not nearly as large as it used to be. So I think from an economic point of view it's more important as a signal that policymakers are there, they're active and ready to act as needed. So it's positive from a sentiment perspective. But I think there are many other factors at play, including continuing that long-term reform agenda, freeing up the currency, making it more market-driven. In terms of the impact on the broader region, we think most currencies will ultimately follow suit. The CNY is one of the most important and most traded currencies in the region. And chances are you'll see, all other currencies also adjust a level lower. That also sort of reflects the fact that most other currencies in the region are also facing a number of challenges. Lower interest rates, smaller current account surpluses, or in some cases, deficits. So when you combine all of that with the largest currency in the region weakening, you should expect most other regional currencies, including the ringgit, to adjust that bit lower.
Now, why would China want to devalue its currency to its weakest level in 4 years? When the currency becomes cheaper, to outsiders, goods made in that country become cheaper too. China has been struggling with slow growth for some time now. Last year, its economic growth fell to 7.4%, and it used to report years of double-digit growth. So in July, exports fell by 8.3%. Chinese manufacturers are now looking at their fourth year of price deflation. So coming back home, we see the local stock market falling even more. From mid-April until July this year, MIDF said nearly 12 billion ringgit worth of foreign funds have exited the Malaysian bourse. This compares with 6.9 billion for the whole of last year. Mind you, we are only in August. Now, the ringgit was also not spared. It has already been battered by falling crude oil prices, by falling crude palm oil prices, by rumours that the US Central Bank may hike interest rates, and of course, by the ongoing issues surrounding Malaysia's political scene. Okay, if you want to know more, check out last week's headlines with our resident money changer, Jason Lim, right here. Malaysia has a significant amount of trade with China. Malaysia's overall exports rose a higher than expected 5% year-on-year last quarter. This was mainly due to the fact that our exports to China rose more than 49%, and this is an indication that China is one of our largest customers. So think about it. If the ability of one of our largest customers to spend has been reduced, then they will be less willing to spend on us. In response, Bank Negara Governor Tan Sri Zeti Akhtar Aziz believes there is no need to do anything to counter the yuan devaluation. She says what China is doing is for its own good, and its effects will eventually smoothen out after initial knee-jerk reactions.
China is adjusting to this international environment. In fact, its currency has adjusted much less than everyone else. So I believe that it is taking into account these two recent adjustments. It has just cumulatively since August of 2014 when other currencies began adjusting, and we have adjusted since then to the US dollar, because we should actually not just look at the US dollar, but against the US dollar we adjusted by about 20%, and China cumulatively only about 3 or 4%. So this is not significant, but it surprised the market. There shouldn't be an overreaction to this move, and if it's good for China, it's good for the rest of us as well.
So there we have it. Bursa Malaysia is still seeing a sell-off. Foreigners continue to sell off local stocks. The ringgit is weaker. Right now it's nearly reaching 3 to the Sing dollar. Check out the other rates here. Until the picture becomes clearer, we should all really just keep calm, tighten our belts, brace for the worst, and hope for the best. So thanks for watching this week's headlines. Sorry for all the bad news, but remember, I'm just a messenger. Don't arrest me. Have a great weekend. I'll see you next week.